In today's video, I am going to show you one of the most insane market nuances that you're ever going to see. One so blatantly redundant it happens every single day on every single asset being traded in every single market located on every single part of this globe. And it's right there in front of you. All you got to do is take it. Now, this specific nuance that I am going to show you is largely responsible for bailing me out of a 6-year self-sabotaging cycle of poor trading performance, huge trading losses, and blown trading accounts. And it helped me become a long-term profitable trader for the last 17 years. And I know that once you learn it, it'll have the power to do the same thing for you. And here's why. Because once you learn this specific nuance, you can put any chart that you want on your screen, and you'll be able to quickly decipher within a matter of seconds with great accuracy whether or not this thing can become the next big mover or the next big loser. You'll slowly start to realize you're developing a sixth sense for market direction, and you can take that information that you see on the screen and quickly translate that into a winning trade formula. Then you'll start to notice that somehow you seem to be in all of the best trades at the best time, ready to capture the best of moves. And once you're able to do this, I tell you, trading starts to become a whole lot of fun. Now, one of the crazy things about this nuance I'm going to share with you is it has absolutely nothing to do with any type of trading indicator or complex market theory. In fact, I would guess by this time in your life, it should be pretty easy for you to implement because it all comes down to just math. Yeah, just math. Now, when I say the word math, I'm not talking about abstract algebra, advanced calculus, or we all need to act like we're Russell Crowe in A Beautiful Mind. I'm simply talking about basic third grade 1 + 1 = 2 kind of math. And if you can grasp that concept, you can employ this into your trading business right now. And I am for sure that once you've grasped this concept, everything that you ever wanted to achieve as a trader will slowly start to fall in line for you. So in today's video, I am going to show you how you can successfully exploit this mathematical nuance. And chances are, once you've internalized this concept, the very next trade you make is probably going to be a whole lot better than the last trade you made. So at this moment, I would like to introduce to all of you my very, very good friend located right here on the screen called The Measured Move. And that's going to be our topic of conversation today. And you're going to like this one. Because like I said in the introduction, it was this theory or concept, whatever we would like to call it today, that was hugely responsible for helping me turn the corner as a trader more than 17 years ago. Because back then when I was new, I was sort of on the war path for the holy grail of trading. Like whatever kind of trading strategy it was, whatever kind of theory, I bought into it. I bought it, I studied it, and I tried it. You know, Elliott wave, Fibonacci cycles, floor pivots, MACD crossovers, stochastics. I mean, I've been there and I've done that. And no matter what I tried, which may be a situation that you're in, no matter what I tried, it was inconsistent as hell. I mean, I couldn't tell one day if it was going to work or if it wasn't. I mean, sometimes I was like, oh, wow, this is cool. It really works. And then the next day, like, this is the worst thing I've ever done. And I would quickly realize that once somebody showed me the measured move, I was totally going in the wrong direction. I was like, boy, if somebody didn't show me this, I would have spent the next decade just blowing up accounts. I was really headed down the wrong path. It was that valuable. So it can take anything that you're using right now and immediately improve it. And I put the definition up here. I'm going to give that to you first because some people like to have the full definition that I took from Investopedia. And then I'm going to give you my definition and show you how to effectively use this. So basically, it's very simple. I'm not even going to read it. You've probably read it yourself by now. It's sort of playing a rhythmic sequence in markets. Just there's always an ebb and flow to a market. Like newer traders somehow think the market goes up or the market goes down. It doesn't. It goes up and it goes down. Then it goes up and then it goes down. And with each one of those moves, they're telling us clues with high accuracy on what is the most likely scenario. Because if you think about it, every theory and technical analysis pattern invented has tried to accomplish the same goal. The number one goal all of us have for a trader, which is what's going to happen next? What is the right side of my chart going to look like if I could draw it out, if I could think it through, right? That's what we're after. To me, the measured move is the ultimate tool for price prediction, for you setting your honest and true expectations as a trader, like what you're going to get out of a trade, and just the creation of trade ideas. So here's what I want to do. I want to do this in steps because I'm going to show you how to use it as a trade idea, how you can manage risk with this, how you can set your expectations, and how you can figure out what's going to happen in most cases throughout the day. So let's move over to the whiteboard and first discuss what is he talking about when he means measured move, because maybe some of you are using this. Somebody has taught it to you. Maybe it's the first time you're hearing it. And usually when you say the word math, I hear that word, I start freaking out. It's just basic adding and subtracting. So let's say, for example, it doesn't matter what we're trading: oil, foreign currencies, cryptocurrencies, stocks, index, it doesn't matter. There's always an open and there's always a close. And let's say hypothetically for this particular example, you opened here and you closed all the way up there. And if you looked at a daily chart bar, it would be bold and green and juicy and great, just like that, okay? So that tells a story from start to finish. But if you're a short-term trader, you're a day trader, you're looking at smaller charts, it does not look like this one big bar. A open to close generally would probably look like something like this, right? A bunch of wild moves on that path, like it took the scenic route from point A to point B. Each one of these moves that you're seeing can, first of all, be predicted in the terms of its size. Size meaning pips, points, dollars per share, or whatever it is that you're trading. The subsequent pull can also give you an idea of how far that's going to go, and if it goes that far, what's going to happen next. So think about what I'm just saying. How many times are you trading intraday and you're like, I bought this, and then all of a sudden it dumps. And you're like, oh, I got to get out. You see a couple red bars, you panic. You see a couple green bars, you panic, right? You FOMO, not paying attention to measured moves. There is, in fact, a rhythmic sequence, and every instrument has a pretty reliable rhythmic sequence to it, and that's what we're trying to exploit. So keeping it simple, let me give you an actual mathematic equation. I can barely say that word. Let's say you are trading something and immediately from the open, it moves straight up. Or in fact, maybe it moves straight down. Strangely enough, this is what you're going to see in most cases, that 99% of everything that's being traded, it's sitting right there at the open and it either shoots up or shoots down, right? The first 5 minutes of the day is like the Wild West and everything. It's like everybody buys or everybody sells. And there's truth to that. So there's going to be this move that takes off on anything you're trading right from the start. Now, let's say it's a stock and it's $50 and it shoots straight up to $53, right? About $53. And it can have a couple of red candles in there. But for the most part, if you were to draw a line chart, it looks like this really steep gradient move, okay? So this is, for this example, we'll just use $3. Try to keep the math easy. That is your first measured move. You got a $3 move out of that. Now, I'm going to go over this in extreme detail in just a minute. I can give you a little clue. Probably when it opened up, you had an idea it was going to deliver $3 to you because the previous day's measured move was $3, if that makes sense. It starts to turn them gears in the head. Now, at some point, as with everything, whether you think it's super bullish or super bearish, it's in a huge uprun. There's always going to be a challenge. Everything's going to reach a point where the market collectively goes, nah, let's wait, right? It could be a minute, 2 minutes, 5 minutes, an hour, but there's going to be a pullback. Let's say for just this example only, there's variations, and I'm going to go over that with you, is $1 per share, okay? Now, again, you're going to learn here that you could probably figure out, based off of the previous day, what that pullback is going to be. And with that pullback, the depth of it can tell you whether or not this thing's going to go back up, right? Or you're not going to get any more money out of it. And you can do that very accurately. But let's go with the basics. First, the measured move. What you have here is a $3 up followed by a $1 down. So in theory, and I'm going to say theory because there are other pieces, as with all technical analysis, I do want to be straightforward with everyone. The more context you have, the better your results. That's why my technical analysis didn't work in the early years, because I just traded a flag patterns and breakout. Oh, it's going up. No, there's more context. But again, get us on the same page. So basically, you can expect perhaps another $3 up move, followed by a $1 down move, followed by a $3 up move. That would be your general overall theory, that move could possibly exist. So for, let's say those who've learned a flag pattern, for example, let me get rid of some of these lines here. That's kind of what the flag patterns theory is underneath of the surface when you peel it back, is that you're buying the base, for example, of that flag that may have coincided with some other context like support or back tested. It was a breakout retest. Again, there's other contexts that we'll discuss. And you've timed that measured move and you've bought that measured move and you're getting in here for the theory. We're all trying to trade the right side of our charts, like looking right there, for a potential $3 up move. That's your target. So it's setting the expectations that I'm buying it, but I'm looking for $3 on another measured move. This might be something here that you see a lot of, is that the experienced trader who studies the flag and understands that is executing in here. That way, if I'm not doing a flag pattern class, I just thought, well, I'm sitting here on this topic, I might as well give you a tip. There's a chance that it fails, right? But the newer trader tends to buy on the break, which is the problem. You've already allowed a big chunk of that measured move to be chewed up, and now you're just, shall I say, cutting your throat. You're just making life difficult on you. And of course, if that fails and this trade doesn't work, in theory, what are we dealing with? A potential $3 measured move in sequence. So if the move fails, then the probability instantly shifts to you might get a $3 move back down lower. So by using the sheer number 3 and the number 1, you've got some sort of formula. As silly as that sounds, that's a formula. And then of course it goes $3 down, then it bounces 1, and then maybe it goes $3 down, bounces 1, and then flat, and then goes up 3 or something like that. Like, so the number 3, the number 1 can consistently be used as just, that's your measurement. That's what you're looking for. And you can actually draw that out, in a formula. So let's go take a look at some charts. I'm going to add some context to you and give you a top-down approach on how to use this thing with maximum efficiency. So let's take a look at some live charts, because there is money that needs to be made. And again, you're going to see how this thing works in a real-time environment. And as I probably mentioned before, it's the extreme of the extreme right now. Market emotions are super, super high. We just come off election and we got the Fed meeting on Thursday. You can't get any more wild than that. And that's the point. If this can give you accurate direction in this type of market, then it should be able to tell you the story in just about any other market, because you're not going to see this type all the time. And on that note, I also want to say that I'm totally exhausted right now. I've been up all night trading this election, like I do every election, because there's such amazing opportunities and we only get them once every 4 years. And I kind of want to let you know that too, because I might just start stuttering. I might just like talk in circles for a second or two. Sorry, but I am so tired. But we got to finish the video. So there are 3 things, the top-down approach I want to talk about to get this to work correctly. And it's just probably 15 minutes before the market opens. So we'll see what we can come up with. Number 1, as with all of my trades I have mentioned in any video I've done in the past, I begin every single day by looking at the daily range. Because we're short-term traders, we just need to kind of calculate the last week or 2 weeks and get a gauge for what is the market doing? Are we above range, below range? This kind of sets the expectation from the start. And the easy way to do it is just look at the bar and count, right? It's basic math. Just count it. Like if you look at a standard green bar here, you got about 20,700-ish, and you go down to 27.3, right? So you got a 300-point move. And if you just look at that, the next day was a little bit more than that. This day was close to that. This day's about that, right? You can see most of the days, there's a few days that are not, but 300 points is a good benchmark, right? So for example, if you're buying it and you're expecting 750 point ripper for today, again, that's pretty outrageous to say that, you're not going to get it. Like back here, when the world apparently is coming to an end, yes. But today, no, you're not going to get that. So you need to set your expectations. And how that works, real simply, I might have mentioned this before, just hypothetical. I'm just talking hypothetical to make this thing go smoothly. Let's say you open up at 320 points. I'm going to try to draw a 2 there. My apologies. No news. We have news now, but no news. Your first move shouldn't be a buy. You've already had all the meat stripped off the bone. You're pushing the range. You need the measure and move pullback to buy. That's what you need to make the risk versus reward good. Same way if it's down 350 and you start in the day, you probably don't want to start short selling down there or selling because it's at a significant pivot of range. And there's so many millions of traders around the world that are just range-bound traders to begin with, and they're focused on these ranges and levels every day, that's why you see all this activity around it. So we just start with that. I have at the bottom the ATR, the average true range. I don't use this, but for all the new people out there that might be, I don't know what that guy just said. I don't know if I can accurately calculate it. Just put the ATR indicator up here. You'll see it says 313. Good enough. We don't need specifics. Just give me something to start with. I'm going to start working back from that. I'm using Thinkorswim. You can go up to studies, click quick study. I believe it's under volatility. Yeah, volatility. ATR is at the top. Just click on it. 330. We got it. Just say 300. We got it. Okay. So we begin with that. Now, right now, at this moment, we're at 330. So on a normal day, which today is not normal, I would probably just short that as you approach it. And look, you're already into resistance, right? So you're having another piece of confluence there. I would just short that. But it's not a normal day. You can see as we started to approach the election, the candles got bigger, right? And yesterday, they were bigger. So we are now expanding on that range. It could go 400, 500, even 6 under these contextual, that's a big word right there, circumstances. So we don't want to just rule that out. But we can't buy it there right away either, right? It's a matter of dialing in the entry and then using the measured move. Because here's what a lot of people are going to want to know. Is the market going to bust through that resistance today? Is the election results enough to power that through? Is the market euphoric enough, emotional enough to just chase this move? Because you're going to find yourself, this is the thing about technical analysis. A lot of the videos that are done, you're looking at the perfect scenario, or the ones that work, you have the perfect scenario. But a lot of times when we're trading, we don't have, like you're in a confusing spot. That's why we say don't diddle in the middle. It's like, it's not an accident that the market usually opens up at the middle or opens up right at resistance. You're always starting the day in a weird spot with a lot of assets. That's why you need these measured moves. Now, let's break this down on a 5-minute and go through this step by step. So here's the 5-minute chart, Friday, Monday, Tuesday. Okay. Again, just look at these moves. This move right here, 20,050 to 20,250. You got what, roughly 200 points there. You got the same type of move all the way down, about 150 here. This move right here, right, roughly 200, 250 points. Then it pulled back. This move right here, right, 200, 250 points. So you're getting like these 200 point moves in a burst, in a sequence. Now that's off of range, but like it was drawn on the whiteboard, that's what it tells you. So if you're beginning the trade in an area like this, which we'll get to in a second, why would you not expect 150 to 200 points? You're not asking for too much. Now, if you're buying here and you're asking for 250 as a day trade for that day of Friday, you're insane. It's not the idea, it's the execution. If you're going to buy, you want to buy before the 200 move. What you would need to do is wait for something like this that has the measured pullback. Then you want to do the buy and look for the 152 point. But that gives you the guide. Now, obviously, you should be thinking at this point, look, there's no guarantees. It might not go 150. It might go 20 and turn around and dump. This is the market. There's always variables, but you need to be prepared. And if you're in the right spot, a lot of stuff is going to just work for you. Same thing here, same move, downward move. And you can see even under this started before any poll results come out. So the market's just ripping. Each one of these moves, 200 up, 100 down, 200 up, 100 down. They're staying, not to the penny, but they're pretty close. So again, A to B, up, down, up, down, up, down, up. And now you're pulling down. What would be the next logical move? Maybe more up. We want to look for that. Now let's look at it where it is right now, because we're just about 5 minutes before the market opens. So here's been the last up move, which has been roughly, let's see, 20,000, say 580, maybe not quite that low, to 720. So you've got about 130. And this is what I'm saying right here. If you take anything away from this video, you can't buy that. You can't buy the 130 top heavy measured move in succession when there's resistance right there. It's okay to buy it in theory, but you would want to buy that pullback, right? And then try to trade that move. Now here it would have failed, but you would have known there was a possibility because it was entering resistance. But see, this is the beauty. By waiting for the pull, you got the options. Better than buying here and realizing it than buying here and realizing it. So here we go. What should we do here? This is probably going to be a buy. We're pulling back from the resistance. This move is roughly, let's say 20,720, 20,660. Yeah, 60 points. This one right here was 20,710. Yeah, we're about the same in distance, and the market's buying it. They're also buying that up at this pivot into that pivot. So this looks like as we're getting ready to open, the market wants to buy this. So let's talk about risk and expectation. I would use for risk on this the entire 100 to 150 point drawdown back testing move. So make this easy. 720, go to 620. There's you 100 points. So you're coming up a little bit short. I would use the stop right there. Now that's wide or even here, but you're under unique circumstances. If you can't give up that much, you can't take this trade. Now there's other contexts. We've been rallying real aggressively off of these turnaround candles. You've got an engulfing candle here. As long as this holds up, experience would tell me with emotions entering the market in a couple of minutes, you're just going to blow through. You're just going to blow right through it. They're not stopping. And if you look at this overall, back it out, you're just constantly making a series. If you take a look at this, it's kind of off topic, but hey, it's here. I'll show it to you. What do you got here for any of those market technicians? Got nothing but higher lows, right? Higher lows followed by higher highs. So this move stops here. It's a higher low. You come up here. This pullback is higher than that. This low is higher than that low. This low higher than that low. This low. That's telling you the market's buying dips. Maybe that's another video there. But this is probably a long. We should probably just take this. I can see they're going to buy. It's a tad bit of a chase now, but look. So there I've got 26,682. 26,682. So let's take a look at what to expect. Now, we're going to put the stop here. And of course, this thing could just come down here and smash you in the face. Right? That happens. That's why you're going to use the stop loss or somewhere down in here. But the point with this is you're trusting that the measured move and the fact that you're getting an engulfing candle here, that's the scenario that's going to happen. Now, there's a little bit of an advancement here in my thinking, and that is you're not even getting down into the full distance of the typical measured move. Now, this happened post-market. There's a little less volume, so some of this stuff gets a little bit more aggressive, but you can see the market's appetite for buying. there's also a little bit of personal front running based off of the trades that have been made, that every time you turn around, you're just rocketing. You're just rocketing. You're just rocketing. You're going to find that. And there could be a bunch of FOMO with that. But what you're doing is putting yourself in a good situation, right, where you know what your risk is. You got to take the chance on the trade. But you're using that risk as the measured move. And as long as the market keeps buying up the measured move or less, it's telling you that secret, if that's what you want to call it. It's telling you we're going to get bought. Like, this is not a short because there isn't any momentum in this downward pull. There was some here, but they bought that up. And they bought that up. And if you want to just think common sense, maybe a little bit of a rant here, but if I see an opportunity to educate, that's exactly what I do. You're running out of momentum quickly, right? So what makes you think you're going to get any more, really, right? I get this. Again, you'll learn these things in time the more you trade. But now we know where to stop. Let's focus on the measured move. What are we looking for? Why not 100 to 150 points? So that will put us roughly 688 to 788. Let's see. For the sake of craziness, I kind of just fast forward, and there is that measured move. So this is a sell. You got that's 700 to let's see, just get a little bit higher there. I'm gonna take this impulsive early move, even if it's a little bit short. And again, the reason for you can make your own choices from this point based off the more you trade, but you've got your expectations. Now, maybe we end up at 20,008, 21, right? But there's probably going to be a pullback. And because of this aggressive nature, we know that pullback could be 100 points. This thing could pull back all the way back down to here. And this chart's still intact. So we don't want to give up our money. I'm going to take this before it turns around. I mean, that's pretty good play at the open. So but I wouldn't buy this again until you got about 100 points shaven off of that. Maybe the breakout retest that matches 100 points that comes back down into here, and then look to buy that dip for another impulsive move. But think about it. You might not feel that's going to happen, but it does, right? You might not think it's going to pull back, but it does. Even though you've been ramping the whole day, it does pull back. And let's say it's the rare situation that it doesn't. That's okay. You have to stick with the formula, because what you do once really doesn't count unless you made 20 million on one single trade, which is probably not going to happen, right? See if they actually pull this back. And if they don't really want to pull it back too much, it'll probably go higher. That's kind of the clue. But I kind of forgot where I was. Told you I was tired. It's what happens over your body of work. If you want to be a long-term pro, it's if I did this 100 times, chase this move, what would be my overall result? You won't even make 100 trades. By the time you get to 10, you'd probably be bankrupt. It might work once, right? Again, the context. It might work once in a bull market on a unique circumstance, but it won't work. So would I normally buy a move like that in a regular market? No, I have context. And I can match that context and create the trade saying, I'll probably get 100 points. I'll probably get 150 points. So you can see how it moves. Now that you've moved 100, 150 points out of the buy, no way in hell am I buying that. I have to wait for the pullback. If we can get 70, 80 points, we can pull back to a support resistance. We can keep buying that. Maybe it doesn't go again, but we can keep buying it. Or dare I say you could short here. Now, I'm not personally in the mood for that, but I couldn't say that was the worst thing. If you put a stop at the high, you might get 100 points. So I decided to skip through for the next hour because I haven't done anything after that trade. I've barely been able to stay awake, and now I got just a split and a headache. But I just wanted to kind of go over what you saw, how you can create a trade from any circumstance, but not just I'm trading to trade, trading with a purpose, with a meaning. We sold that based off of what we thought was the measured move somewhere up there. I mean, you're never going to get to the tops and bottoms. I thought, maybe it was a short. I wasn't willing to do it. The market's just too radical for me to go to that side today. Normal day, maybe. It's not normal day. But look, you did kind of get a little bit excessive, but look where that bounced. It did get into there, right? Did get back down into that support there on the 5-minute, coinciding with this area right here. And what did you end up getting? Another 100+ point bounce. Also, use that measured move in terms of giving you the clues. What you should take away from this is the serious impulsiveness. Let me put impulsive here. It's the impulsiveness of this market under the news. The emotions, I said in so many past videos, emotions are the abandonment of intellect. People really, truly are tilting here. And they may continue to do this for several days. Maybe this rally just gets so euphoric. It's not like we can't just go nuts on something like this. That's why you can never say never in the market. Could this end up all the way down here? Yeah. According to the way it's just, more higher lows. Look, it continues on that trend. Probably just nibbles right in there and starts just rocket launching back off. This is why you have to use the measured move and the stop. Let's say that you did buy it into this base. If you had a tight stop, you would know that if you lost that range, you would go to the bottom. Then you could try it again. You're not losing money in droves on your bad trades. And I would expect, again, based off the way this is, it's going to continue to push up there. And you can do this with any stock, any asset. But just kind of highlighting, let me go back to one thing here. Pulled up the whiteboard for everyone, okay? Because I want to make sure I don't, like I said, I'm tired. I'm just talking in circles. I'm trying not to do that. Trust me. I want to make sense out of what I'm talking about without getting hyper. So when you're looking at the measured move, you want to take your overall daily range first. I'm sure you guys got that. This will set the tone of what to expect with the trades that you're going to take on a day-to-day basis. Now, when you're measuring that move, that's what is really preparing you for. So first start with this with your trading business. Start calculating those measured moves. Look left on the charts that you're trading and see what you expect. And it makes just common sense, just perfect common sense, that if you start getting rampish up here, you just can't buy it. You've got to wait for your measured pullback. Start looking for areas of resistance up the ladder, past resistances on whatever chart you're looking for. Look at these past resistances and say, well, if it tacks on another 50 points, that's 200 points, that's going to coincide with that or coincide with that. Then start preparing for either to sell, short sell if you want to scalp, or wait to see what kind of measured move that you get off of that trade. Same way if it's going down, where's that stopping point? Calculate that measured move. Where are there supports down the ladder? And will it find a buyer there and turn around and bounce a portion of that measured move? Now, I've done some strategies about wicks, like inverted hammers and inverted hammers. I got it backwards. Engulfing candles, power of towers, sort of reversals. This is where you would need your strategy to dial in the reversal. You'll still need a signal from the market to show you that it's ready to be bought, but you'll know, like, all the way up here, while this is dumping and everybody's freaking out, you're already down here looking for, I bet this thing's going to go 20, 30, 40 points more down. They're going to find a buyer in here and it's going to shoot 30, 40 points back up. And maybe it ends up all the way down or all the way back up, but you're just trying to play that. You're just trying to play that piece. So kind of keep that in mind. I'm going to call the video here. As always, guys, I want to thank you for your participation. If I left anything out, which I'm sure I did, I probably watch this thing back and go, dude, you're just talking in circles. I'm sorry. Like I said, I'm really, really tired. Got a super headache. And man, what a day it's been. Probably going to be done for the week. But if I left anything out, just reach out to me. I'll answer your questions the best that I can. I want to thank you for your support, for watching this channel. It means a lot to me to share my education with you, or just try to help you get better. So if I did forget anything, you know how to reach out to me. As always, go to therumors.com, RUMERS. That's how I spell my last name. It's not with an O, it's with an E. And I'm going to start doing educational videos every week that I'm not posting on YouTube. They're free. It's all free. So feel free to sign up on that. And on that note, guys, thanks. Take care. Trade well. We'll see everybody here in the near future. Cheers.